a $1.75 trillion valuation, $85.7 billion raised, the largest IPO in history by a wide margin. And in the weeks since, it's forced Nasdaq to rewrite its own rulebook and even changed the actual number of companies in one of the world's most watched stock indexes. Let's go through exactly how. This is a story about a record-breaking IPO, a brand new rule built for exactly one company, and what it actually means when a stock joins a major index, including for people who never chose to buy it. Before this, the largest IPO in history was Saudi Aramco's 2019 listing, which raised about $29 billion. This new offering raised roughly $85.7 billion, nearly 3 times the old record, at a valuation between $1.75 and $2 trillion. The stock priced at $135 a share, opened at $150, and closed its first day at $160.95, up 19%. More than 500 million shares changed hands, the second highest single-day IPO trading volume ever recorded, behind only Facebook's 2012 debut. By the end of day one, the company's market cap reached roughly $2.1 trillion, instantly making it one of the most valuable public companies on Earth. Most IPOs hand the best shares to large institutions, leaving retail investors scraps. This one reserved roughly 30% of the offering for ordinary individual investors, several times the usual allocation. Demand was so intense that the order book was more than twice oversubscribed, and the retail portion sold out entirely before trading even began. Here's something most investors never think about. When a company goes public, it doesn't just join a major stock index automatically. Index providers normally make new stocks wait anywhere from 3 months to a full year before they're eligible to be added. Nasdaq created an entirely new fast entry rule, effective from May 2026, letting sufficiently massive new IPOs join the Nasdaq-100 in as little as 15 trading days, as long as the company ranks among the top 40 holdings by market cap. This company easily qualified, and here's the detail that makes it genuinely unusual. The rule doesn't require removing any existing member to make room. Nobody was kicked out. The index simply expanded past its usual 100 company count. On July 7, 2026, this stock officially joined the Nasdaq-100, just 15 trading days after its IPO, and as the very first company ever to use this new fast entry rule. For that moment, the index that's supposed to hold exactly 100 companies actually held 101. Here's the twist. Nasdaq fast-tracked this stock. The S&P 500 did not. Its rules require 4 consecutive quarters of actual GAAP profitability before a company can even be considered, and this company doesn't clear that bar yet. The company's most recent full-year revenue was about $18.7 billion, up 33% year-over-year. Genuine growth. But it posted a net loss of roughly $4.9 billion over that same period, and the loss actually widened in the first quarter of 2026. Only one segment of the business is currently profitable at all. Everything else, including its most ambitious ventures, still runs at a loss. This is the part most people never think about. When a stock joins a major index, every fund that tracks that index is mechanically required to buy it, not because they've analyzed it and like it, but simply because the rules say they must hold what the index holds. This is called price-agnostic buying. The fund buys regardless of what it thinks the stock is actually worth. Normally, a stock with very few shares actually available to trade gets a smaller weighting in an index, since there's less of it to go around. Only about 4% of this company's shares are public. But Nasdaq's new rule does the opposite. It gives low-float mega IPOs a weighting boost, pushing that roughly 4% float up toward an effective weight closer to 13% for index tracking purposes. Added up, and estimates put the total mechanical buying triggered by this one inclusion date somewhere between $22 and $35 billion, once you count every fund tracking the Nasdaq-100, the Russell 1000, and global index providers. One bank alone estimated over $4 billion in buying just from the single largest fund tracking the Nasdaq-100. This hasn't been a smooth story since debut. On June 22nd, shares fell more than 16% in a single day as early profit-taking kicked in. Since then, the stock has traded in a wide range, and professional analysts covering it are split almost evenly between buy, hold, and sell ratings, a genuinely rare level of disagreement for a company this large. The company's founder holds roughly 85% of the voting power through a dual-class share structure that gives his shares far more voting weight than an ordinary investor's. Legally, this is entirely standard practice for a founder-led company going public. But it means that ordinary shareholders, including everyone whose index fund now holds this stock, have essentially no meaningful say in how the company is run. Around June 10, 2026, Senator Elizabeth Warren sent a letter to the SEC urging it to delay the offering. Her argument had three parts: that the valuation had run ahead of the company's actual financials, that the dual-class structure concentrated too much control in one person, and that fast-tracked index inclusion could force ordinary retirement and index funds to buy the stock whether their holders wanted that exposure or not. The SEC did not delay the listing. Its review focused on whether disclosures were adequate, not on whether the valuation itself was fair. Here's why all of this matters, even if you have zero interest in this specific company. If you hold a Nasdaq-100 index fund, a Russell 1000 fund, or a total market fund, you now own a slice of this stock automatically. You didn't pick it. Your fund's rules did. That's not a flaw exactly. It's simply how index investing works. But this episode makes that mechanism unusually visible. Despite the losses, investors paid $1 trillion-plus valuation on the strength of the growth story, a dominant position in its core business, an enormously recognizable brand, and ambitious future plans investors are betting will eventually pay off. Whether that bet is justified is genuinely, honestly disputed, which is exactly why analyst ratings are so split. This may just be the first of several enormous IPOs this year. Other major AI-era companies are reportedly weighing their own public listings in the near future. If even one of them approaches this scale, we could see this exact fast entry playbook and this exact forced buying dynamic play out all over again. The listing triggered a broad sympathy rally across other space and AI-adjacent stocks, all rising on the momentum alone. It also reopened an honest, ongoing debate, one we've covered before on this channel, about whether parts of today's AI-driven market have reached a genuine valuation extreme, or whether the growth still justifies the price. Strip away the specific numbers, and the real lesson here is mechanical, not directional. Index funds don't decide what to buy stock by stock. The index's own rules decide for them. Understanding that mechanism is more valuable long-term than having a strong opinion about any single company, including this one. Let's pull it together. This was the largest IPO in history, $85.7 billion raised at a valuation over $1.75 trillion. Nasdaq built an entirely new rule to fast-track it into the Nasdaq-100 in just 15 trading days, And that rule didn't remove any existing member. The index simply expanded past its usual 100 companies. The S&P 500, by contrast, declined to fast-track it, citing a lack of GAAP profitability. And if you own a Nasdaq-100 or total market index fund, you likely now own a slice of this stock too, whether you individually chose to or not. An index fund is supposed to be the simple, hands-off way to invest. Buy the whole market. Stop worrying about individual picks. But we just showed you a case where the index's own rules made a very large decision on your behalf, without asking. So the natural next question is, what else is quietly built into the index you already own? That's exactly where we go next. If this gave you a genuinely clearer picture of how record-breaking IPOs and index inclusion actually work behind the scenes, please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow. See you in the next one.